cold. Spent way too many years in it.
You're missing out on all the slush.
Oh yeah. I don't miss it at all.
We've had such a mild winter.
Yeah, we have. I know there's only been really one big snowfall, right? And so we've only made one snowman this year. This is like a record. And it fell over the next day too, because I guess it warmed up a bit, or it was raining, I think, a bit. That kids still had fun though, so that's what it's all about.
All right, so you know what?
Not only recorded but live streamed. Okay.
No pressure. Just ignore that. Don't worry about it. So
pretend you didn't read that. Not only recorded but live streamed.
Pressure. Just ignore that. Don't worry about it. So, you'll have we actually will get people coming on now, but you know what, for the moment, you know what, maybe people are going to watch it, so maybe give people an idea of what you do, Amiel, and what kind of people you work with, what you specialize in, and what kind of people should be hitting you up for some help. I'll
just give like a bit of my background as well, so that just so that people know where I come from and where I've been. So I'll start. I'll try and give the Coles Notes version. If I go too long, just cut me off. But it all started way back in the day. It actually started back in 2005 when I graduated from engineering, and that was my first job. I was a mechanical engineer, and right after I started working for the company that I was working for, somebody handed me the book Rich Dad Poor Dad. So I read this book, and of course my immediate reaction was, should I have gone to university? Should I, should I have done all that? But definitely no regrets. Engineering taught me a lot, but it definitely changed my outlook going forward, right? So from sort of that point on, it was reading lots of books, getting educated on real estate investing, because that was definitely something that was of interest to me. Took me a while to get started. I bought my first property in 2007, and then another one in 2008, and I was sort of doing it slowly. And then in 2010, I heard about these courses, and the funny thing was that my wife, who's not really interested in real estate investing, but knows that I was, knew that I was, she saw this ad on Facebook for this training, and she was like, "Hey, you should check this out." And I was like, "Oh no, I don't really want to go. I'm introverted and I don't want to meet people." And she was like, "Well, you know what? I'll come with you." And I was like, "What?" I was like, "Oh, that's a little crazy." So I went, right? So I went, and of course it was that, just that hour intro that sells you on the next training, and then there was the next training and sold you on the next training. And honestly, skeptical the whole way along, but I moved forward with it, and it completely changed my life, right? So that really accelerated my investing career. So that was back in 2010. Started investing heavily in real estate. My strategies were rent to own and multifamily properties. So we started, rent to own, multifamily, rent to own, multifamily. And then by 2012, that's when I had my second child. I took 3 months off for mat leave. And after a month, I called them back, and I was like, "Listen, I'm not coming back. It's just not going to happen." It was too much to do both at that time, right? And we were doing really well with the real estate business, so so I continued on with that. And I had met somebody through the courses that we did all the investing together, so we partnered up and worked together. I think that's while not always necessary, it's definitely a benefit, right? And I was that introverted person. I was an engineer. I was very good at doing, the math and working out the numbers and all that kind of stuff. And the person that I partnered up with, he was really outgoing. He was a realtor. He had, no problem talking with new people and getting out there, right? So our relationship worked really well. So fast forward to 2014, I saw that my business partner was a realtor, and he was sort of double dipping on all the deals that we were doing as a realtor. And I was like, "Hey, you know what? That sounds like a good idea. Why don't I get my mortgage license, and then I can double dip too?" So that's what I did. 2014, I got my mortgage license, and not expecting it to go anywhere at all, except for doing some deals for ourselves, maybe a few friends and family, that kind of stuff. But It just, one person told another person, and it basically took over my life eventually. My business partner and I ended up splitting ways and going on and doing other things. And so we ended up selling our portfolio. We had got over, I think total, we were over 200 units, in our portfolio. We ended up selling them all. I do mortgage, now on the investment side of things, I do mortgage lending myself. So just private lending and hard money lending. And to be honest, I love it. It's from a time perspective, having your money work for you is much easier than having you work for money. So it's
Be the bank.
Be the bank. That's exactly it. They have the tallest, nicest buildings for a reason. They know what they're doing. So and then on the mortgage side of things, it really expanded. I now have staff that work for me. I've got 4 staff members, a couple of underwriters, and a couple of admin. And I sort of go back to that Robert Kiyosaki thinking of that big business, right? If I'm just a self-employed individual and I've got to do everything myself, I really haven't gotten myself anywhere, right? But if I sort of look at that, be on that big business side, be it we're still a small business, but but with that mentality where I'm not the one that has to do everything, right? Having staff do it for me so that I can do the things that I want to do. I mean, I got into this business for being able to spend more time with my family and have more time for myself to do the things that I want to do, right? Instead of working for somebody else and doing that until the day I die. So that's sort of me in a nutshell. In terms of the mortgage business, I'm on a team as well. It's called the Windrose Group. We are a mortgage alliance team. Mortgage Alliance is the brokerage. And of course, based on my past experience, our clients are primarily investors. So 75% of my business is investors, and we do, basically everything under the sun. And I know that's not necessarily something you want to hear from a broker, but in reality, I do have staff that work on different parts, and just having the experience that I have, we're able to do that. So we do, regular home purchases to, large portfolio financing for investors, buying, just simple as buying your first property. And then we get into commercial stuff as well. So we get into like large commercial buildings, multi-unit, true commercial retail, office buildings, industrial, we do all that kind of stuff as well. And then a big part of it is private financing, right? Working with investors is, if you're not doing private financing, then you're missing out on a big part of it. So that's me in a nutshell. Any questions on that? Anyone? All right. So, sorry, Robbie, you were there.
You know what, Amiel? We have a very similar background, because I met Alan doing that. Yeah. He's an engineer. He's now a mortgage broker.
Yes. See, now
and your business partner was my mentor, and you were his mentor.
That's very true. When I was mentoring him, I did not tell him to become a mortgage broker. He did that on his own.
Yeah.
But it's yeah.
Well, he's enjoying it.
Yeah, that's
he's
good.
going to do very well with it.
That's awesome. Engineers do, like, I think we have that analytical side that makes us very good at mortgage brokering. So it's it's cool. So Rob, I know you had given me a couple of topics. I can sort of touch on those topics a little bit.
That would be awesome.
Okay, so basically topics you gave me we're talking a little bit about working with a broker. How do you do that? Do's and don'ts, that kind of thing. Private financing is certainly a big one, so I can touch on that as well. And then, given that I do commercial financing as well, I'll touch a bit on commercial financing, because that is a completely different beast when it comes to mortgages. So, I'll just start off with and again, not sure everybody's experience level or even those that are watching. So I'll sort of start off with the basics and move up from there. But basically, working with a mortgage broker, what they do is they go out and they source funds for you. The way that I like to look at it, though, is that we're not just somebody that's getting a mortgage for you. We are really positioning your package, your information, and presenting that to a lender. So the way that I look at it is we are the filter between you and the lender. We take all the information that you give us and we present it in a way that is going to make it attractive for the lender. And it's not to say that we're definitely not doing anything illegal or wrong or anything like that. We're not changing information. We're just presenting it in the right light, right? Which is certainly important. So one of the things that I definitely want to stress when you're working with a broker, and I learned the hard way, is is not to be working with multiple brokers at the same time. And it's funny, like, you know, when I first started investing, I didn't know what mortgage brokers were, right? And so I was at the bank, and then I heard what they were, and I was like, oh, this is amazing. Somebody that's going to go and source me the best financing. That's amazing. I want to do that. And I had met a couple different brokers, and I was like, well, let's just see who gives me the best rates, right? So both brokers there were two brokers that had my information. They were sourcing funds for me, and I got into trouble, and they got into trouble, because they submitted information to the same lender, but it was slightly different. And again, this is not that anybody is changing information or hiding information. It's just that they're presenting it differently. And so when a lender looks at that and they see two different, you know, slightly different stories, they think that somebody's, you know, doing something wrong, right? And that's why it's important that for one file that you're working on, you're only working with one broker. Or if you're buying multiple at once, again, you should be using that one broker, or you can get yourself into trouble. And you know, if somebody's not doing a good job for you, of course you can switch, right? I'm not saying to do that if somebody's not doing a good job, but if you do move to another broker, you have to tell the first broker to stop working on your file. You also have to get a list of all the lenders that they've been working with, so you can pass that along to the new brokerage, the new broker, so that they know what they're dealing with, right? So that's definitely one very important piece of information that I learned the hard way. Like I said, luckily I didn't get cut off from any lenders, and my mortgage broker didn't get in too much trouble, so that's good. I was still able to work with them moving forward, so that was a good thing. The other thing is,
Amiel,
yeah,
just a quick question or a quick comment on that. A lot
Absolutely.
of people, especially when they're beginning, are of the mindset, because when we buy our homes, we're always looking for the best rate, right?
yeah,
And it's not always the best rate that is the best solution for you. You're looking for the overall package. So I think sometimes when people will go to a mortgage broker and you're telling them this kind of rate and they're seeing different rates posted,
yeah,
their mindset is, well, he's not getting me a good deal. I'm just going to go ask somebody else and see if they can do it. So they really need to understand it's not just the mortgage rate that they're looking for. And that's why they need to communicate their long-term goals to you when they're going for a mortgage for a property right now. It's not just about today, it's about next year.
that's absolutely right. That is exactly right. You know, so any broker that you're going to and saying that you want to buy some investment property, you know, they should be asking you what your long-term goals are, right? Is this the only property that you want to buy, or do you want to, you know, buy one a year? Do you want to buy 10 a year? You know, what's your sort of end strategies, right? Are you doing rent to own? Are you doing flips? Are you doing the BRRRR strategy? Are you buying multifamily? You know, you should be packaging, or you should be talking about all those things with your mortgage broker, because that is very important. And you're very right, Rob, that you know, rates are certainly not the most important thing. As investors, to me, being an investor as well, it's the most important thing is access to capital. It's not necessarily about the rate, it's about access to capital. And so, excuse me. And so it's important to look at the long-term strategy, like Rob's saying. There's definitely what we call a lender strategy when we're getting mortgages. So if the plan is to buy, you know, 2 a year for the next 5 years, that's 10 properties. You know, it's easy to get cut off with lenders as you go along, but some lenders will allow you to do, you know, they will allow you to do 10 properties. Some will allow more than that. And so it's about positioning it properly to say, okay, well, we're going to go to this lender first because they're, you know, let's say the most strict, right? And so we're going to get those mortgages first. And then the other ones that are a little bit looser or a little bit, you know, more flexible, we're going to go to those ones next, right? It might mean that we're getting a little bit higher rates up front for those initial lenders, but in the long-term gain, it's going to help us. It's going to help us moving forward. So that was, you know, sort of exactly my next point is make sure that you are telling your broker everything, right? Not just about this specific deal, but also about other deals down the road. You know, what are the plans? You know, and how do we want to get there, right? And if you have, and I know because I've been, you know, on that side as well, right? You know, I started off, I didn't have a lot of capital, right? So, you know, you have to tell your broker those things. You know, where, you know, so from a down payments perspective, right? Where are we getting a down payment? Well, if the plan is to get joint venture partners, well, that's no problem, right? We can work with that, but you got to let the broker know that up front so that we can work with that, right? so that if we have to get joint venture partners involved, well, let's do that, early on in the process, so we know what those joint venture partners can qualify for. And I know I've certainly seen it, right? If a broker is turning you away because you don't have down payment and because you want to work with joint venture partners, then maybe that's not the right broker for you, right? You want somebody that's willing to work with you and grow with you, because that's how I started. I started with no capital, and I grew to over 200 units in the portfolio, right? You've got to start somewhere. Anything else on that, Rob, that I missed?
You know what, and also one of the things that you start picking up on as you start building your portfolio, work with a mortgage broker, not a bank, because a mortgage broker, and especially a mortgage broker who's accustomed to working and experienced with working with investors, who is an investor themselves, will have access to private lenders. They'll know which B and C lenders to go to for a particular project. You're not going to go to a bank or to pick up a flip. You're going to go to a mortgage broker who can get you access to funds to purchase your flip with flexible terms. And we tried working with many mortgage brokers when we started building our business, and now we're just working with you. Like, it was trial by error, and it's not that the other people weren't qualified, it's also the fit with people, the access to people, and and on our end, we had to understand the value of your time as well. So making sure when we're working with you to get you the information how you need it, right? So we just have a Dropbox, and here's the Dropbox, and and what our goals are, what we're trying to do. So not everything works out exactly as planned all the time.
That's
we're going through that now.
That's just life.
But there's a plan B and a plan Z, and as long as we're communicating with you, it makes things a little bit easier to get through any problems we might be having. So
yeah,
communication. You got to treat your mortgage broker, your lawyer, and your accountant like they're a spouse. Yeah,
and you have to be able to, they have to be approachable, right? If you're scared to approach them because you're scared of what they're going to say, then that's not a healthy relationship for sure, right? You should be able to go to your professionals with any questions that you have, right? And that's that's super important. And it's also important that you as well, that they have the knowledge and the skills and all that kind of stuff, but that, like you're saying, Rob, that you can get along with those professionals, right? You have to feel that synergy, for lack of a better word there.
Oh yeah, I can't work with people I don't like personally anymore. I don't want to anymore. You'll see, if you go in the chat, you're going to see some questions. Probably better if you read them than if I do.
All right, sounds good. Oh, geez, I'm missing these. Okay. Do you work on a deal per deal and work with an investor, or work with the investor and then act when the investor finds a deal? So we work with the individual, right? So we work with you as an individual. So the first step, so even if you don't have a deal, honestly, you're better to start working with a mortgage broker right away, so that you know what you can get and you know what your limitations are. And like I said, if it means that if you go through the qualification process and you figure out that you can't qualify for anything, it's not the end of the world, right? A mortgage broker can then tell you exactly what you need to do in order to get to a position where you can purchase property. And maybe in the meantime, it's working with joint venture partners to get to that point, right? So we work with the individual themselves, right? So we work with you and any of your joint venture partners that you're bringing along. And the first thing that we'll do is do a qualification for you and see what you can qualify for, keeping in mind all your long-term goals and things like that. So yes, so I hope that answers the question, but if there's more to that, feel free to ask. So Ken asked this when the time is right. Does Amiel work with a tenant buyer on improving their credit? Yes, so I still work with rent to own. I still do tenant buyer qualification for the investors that I work with, and I will work with tenant buyers as we go along. The first thing that we do is it's just like a mortgage application. We take theirs, we figure out why they can't qualify, And then it's putting together a plan for them on how do they get qualified? What do we need to do in order to get them qualified? And then we will follow up with them as we go along. There are also other companies out there that just focus on credit itself. So they will, they will meet with them on sort of a more regular basis, and make sure that they are moving along with their plan. So there's lots of different ways of doing it, but certainly that is something that we do. And the exit financing for rent to owns is definitely a bit tricky as well. So you want to make sure that you're working with the right broker to make sure that the tenant buyers can exit at the end of the program, because not all lenders do rent to own. So it's it's important. Another question. So I had never excuse me, I'd never even thought of using a mortgage broker until I took the education, right? Yeah, that's awesome. Thank you for the comment. I'll be honest, I was the exact same way, right? How do you know? They don't teach you this stuff in school, right? The only way you
everyone's the same.
Yeah.
One thing we noticed when we were starting out, when you start speaking to some of the bank mortgages, they have
timing was funny.
Clue.
Yeah.
They have no clue what all of their own products are, let alone what other banks are offering, right? And of course, they're not going to point you to other banks. So you're always better off working with a mortgage broker who knows what's out there. And what I liked about you actually pointed us to work with a bank once where they weren't working with brokerages.
Yeah, that's right.
Don't be cheap. When you have a mortgage broker who's willing to do that, pay them their fee. Yeah,
there are lenders. Right. Yeah, there are banks that don't work with mortgage brokers. They're not in what we call the broker channel. And us being the brokers that we are, we know that those products can be valuable as well. So we do have contacts with those banks and we can help arrange that financing. But given that we're not being paid by those lenders, like typically a mortgage broker will be paid by the lender that they're providing the mortgage to. But in those instances where they don't work with brokers, they don't pay the broker. And so in that case, we would be charging a fee to you as the borrower. And that would be the same, similar to like private financing. Private financing, the lenders don't pay the mortgage brokers, so the mortgage broker charges a fee. Typically 1%, it can vary depending on the complexity of the deal and things like that, but that's typical is 1. And that'll always be discussed up front. And you will always have the option on whether you want to move forward with that or whether you want to approach the bank directly. The one thing that I will say is that, not to knock banks, like I don't want to necessarily knock banks, but when you as an individual go into a bank and say, hey, I'm looking for a mortgage, you don't necessarily know who you're being partnered up with, right? You're being sort of given to the next person in the queue and you have no idea what their experience is, right? They may do one mortgage a year, right? And just not have that experience. They may be more focused on, opening up savings accounts and things like that, right? And not be focused on mortgages. And you're not going to know that unless you ask the questions, right? So it's something to keep in mind. Somebody asked whether we work with investors outside of Ontario. So we certainly do. We do work across Canada. The sort of caveat is that each province has their own licensing. I'm not licensed in every province, but when we do go to another province, then we just work with a broker that is licensed in that province, and I just have them sign the disclosure paperwork on our behalf. So there's a disclosure that we would get you guys to sign up front saying that you're okay with that. And then there's no impact to you. There's no extra cost or anything like that. The benefit is that, we understand your portfolio, right? Like if we're the ones working on your portfolio, we know what you're buying over here. We know what you're buying over here. And again, we can strategize, right? The lenders are the same across Canada. It's just that in order to sign the paperwork, we need somebody that's licensed in that province. The question on, do we have time to touch on refinance versus HELOC? So if you guys are okay with it, we can certainly touch on that now, and there's no real agenda, so so we can just jump around wherever we like. I don't have a problem with that. So and I don't know, Rob, maybe you want to expand on that a little bit. I'm not exactly sure.
Yeah, sure. So let's say you're in a mortgage, you found a deal, you want to grab some money. So to do that, you have to now refinance. You might have a year or two on a term left versus getting a HELOC. Now, of course, if your term is up, you're going to refinance anyways. And then while you're doing that, you consider, hey, you know what, can I grab some extra money?
Yeah.
Or there's another instance, you go and refinance, extend a term, get a new term. And then you're asking at that time, can I also get a HELOC? So there's those options, like what's the best option?
What's the best option? So it is a good question, right? And unfortunately, the answer is going to be a little bit of it depends, right? So every situation, I guess, is a little bit different. However, you know, I am a big supporter of getting access to capital when you don't need it, right? So to be honest, if you are looking at buying rental property, that should be one of the first things that you're looking at is, you know, do we refinance your primary residence now to open up that home equity line of credit? You know, so that you do have that access to invest in property down the road. You know, if you're leaving it to the last minute, sometimes it can be too late, right? So my opinion is to do those things up front. Now there is definitely a like you have to be cautious, right? You don't necessarily want to go and max yourself out right to the limits. I mean, if you can, then fantastic, do it, right? But if that's going to then impact what you can qualify for buying a rental property, then you have to be cautious, right? You have to be looking at, okay, what am I looking to buy? What am I looking to do? Now, there are some lenders that will look at a home equity line of credit and say, well, okay, I'm only going to take into account whatever you've used on the home equity line of credit. And that's amazing because then we can get, you know, a limit of whatever we want, but only have to qualify based on what we've used. And that's amazing, right? If we can do that, then that's great. There are other lenders that will say, well, I don't care how much you owe on your home equity line of credit. I'm going to assume that it's maxed out because you have access to that and it's so easy just to pull out that extra capital, right? So there's definitely some caution there. And which lenders do we want to go to down the road? You know, and that sort of strategy, right? In terms of, I think a little bit of the question was, you know, do I pull out capital as a mortgage or do I pull it out as a home equity line of credit? Was that sort of part of the question as well? Yeah, that's definitely a good question as well. And it can, again, depends, right? Depends on what you're doing. But if you're planning on keeping a property long term, then certainly it might not be a bad idea to take that as a mortgage. The one thing that I'm going to stress is that from a tax perspective, you want to make sure that you're segregating the portion that is allotted to your primary residence to the portion that is going to be used for investing purposes, because anything that you're using for investing, you can write off the interest as a tax deduction, right?
And I guess an accountant would actually show you how to segregate that, or
well, the accountant's not really going to. It's going to be the broker that's going to set that up for you at the beginning, right? So we have the ability, and again, not every lender is the same, but most lenders will allow you to have separate portions.
Dad, go in the back. Can you take off his shoes too, his boots?
So I'm not sure if yeah, okay, thanks, Rob. I'm not sure so you could set it up to say, let's say your primary residence is 500,000, right? Your mortgage on your primary is 500,000. When you can make one portion of the mortgage 500,000, you can get another portion then that's say 200,000, and that's going to be used for investing. So you want to, if you can, you want to separate those rather than just do it on paper. You physically want to have those separated. So you would then have two mortgage payments every month. You would have one mortgage payment to the 500,000 mortgage and one mortgage payment to the 200,000 mortgage. And it's better to separate it that way because there's no questions, and CRA can't, you know, come back and, you know, and talk to you about, you know, come after you and say, well, no, that wasn't, you know, that's all just part of your primary, right? It's better if it is segregated and separated. The other thing I'll mention while we're talking about this subject is when you're getting a home equity line of credit, again, different lenders have different products and things like that. But if you can, you want to get a home equity line of credit that is re-advanceable. So for instance, on that example of the $500,000 mortgage, if you have a $500,000 mortgage and you're paying your payments on a monthly basis, when you pay down the principal, then that automatically transfers to your home equity line of credit. So if I make a payment and $1,000 goes to principal, my mortgage is now $499,000. And I now have $1,000 more available on my home equity line of credit. And so then you can then use that $1,000 to invest in real estate. Part of that, there's a whole strategy around that. It's called the Smith maneuver. And it's about taking your non-tax deductible interest and moving it to tax deductible interest. It's really interesting. And I won't get into the whole thing today, but I'll just sort of give an example that is really, really neat. It is, if I have, let's say, $10,000 and I want to invest that somewhere, am I better to just take that 10,000 and invest it, or am I better to pay down my primary residence? And the answer is, in reality, you're better to pay down the mortgage on your primary residence for that $10,000, because then you're going to be paying less interest that's not tax deductible. And I can still invest that $10,000 because it's moved over to my home equity line of credit. I can take that 10,000 and I can invest it from my home equity line of credit. So that's just, sort of one example. There's lots that go along with it, but it is about, paying down your primary residence as quickly as possible. And honestly, as a mortgage broker, and it's a bit backwards, but that's my goal, right? My goal is to make sure that you don't have a mortgage on your primary residence, right? I think that everybody should be mortgage free as quickly as possible. Yeah.
Another thing I've heard too is Smith maneuver, and I can't even get the words out this morning.
Yeah.
But for folks over 50 type, and there's something you got to be cautious about. It's much better for 50 and under, although you can still apply, but we need somebody sharp like you to really know the maneuvers.
You're saying once you make it to age 50?
Yeah, with that kind of strategy to apply for investing and whatever else you want to do.
I'm to be honest, I'm not 100% sure like what that is referring to. Keep in mind, I'm not an accountant, right? So I don't know the sort of, everything there is to know about accounting, but in reality, the strategy is the same, I guess, regardless of how old you are. In terms of qualifying for a mortgage, yes, there are, once you get older, it does get a little bit tougher, but in reality, like, we're talking like 70, 75, when it starts to get more challenging. It's more a function of income, is that income going to continue, and those types of things. So 50, I think is too low of an age limit sort of thing. I would suggest that it would be much higher. But it is a valid point, and kind of go back to the same thing that I was talking about before, is to access the capital when you don't need it, right? So if you're waiting until you're 65 to do whatever it is you want to do with your primary residence, it might be too late at that point, right? If you're already retired and your income is not as good, it might be tough to qualify for a mortgage at that point. So you're better to get that home equity line of credit set up as soon as you can, while you don't need it, right? It's the same thing. Like if you lose your job, well, they're not going to give you that home equity line of credit, right? Get it while you don't need it. That's, good takeaway for today, for sure.
Could I steal the light a little bit longer if I could? Just another question regarding when you get a mortgage, they don't recognize a corporation in some cases from lenders. And then you have to go and open up a joint or a private account dedicated to making this now your business.
So in terms of recognizing the
you want to run the mortgage to a corporation, lenders like, yeah, no, we're good. So now it's brutal. So
okay, so it's kind of like buying real estate in corporate name is what you're kind of getting. So it is still a possibility for sure. There are lenders that will allow you to borrow money with your corporation. Not every lender does it anymore. There's certainly a lot that have taken that off of their books because they want to stick to just the regular mom and pop shop type thing. They, once it gets into corporate, they think, oh, you're too big for them. But there still are a lot of lenders that will do it. So the mortgage can be placed, so the property can be purchased with the corporation, the mortgage will be placed in the corporation's name, but you as an individual, being the shareholders of the corporation, will still need to guarantee that mortgage. Okay, so it is something, definitely something to keep in mind. Most of the lenders that will do those mortgages will also register those mortgages on your credit bureau when it's a residential mortgage. Okay, so something to keep in mind as well, because if your plan is to get into corporate mortgages so it's not registering on your credit bureau, that's not necessarily the case. That's for A lenders. That would be like your big banks and that kind of thing. When we get into commercial mortgages, which are typically in a corporate name, those are not, typically they are not registered on your credit bureau. So there's definitely lots of factors. And again, things to discuss with your mortgage broker, right? As to should I incorporate, should I not incorporate, right? And then how is that going to affect me in terms of getting financing? But definitely from an asset perspective, corporate name is definitely the way to go. Like we had corporations, we had like a spider web of corporations. It was, by the end of it, it was got a little bit ridiculous, but but yes, it is still possible, and don't let you hold that back, and don't let that hold you back, right? There are lenders that will lend on in your corporate name.
Cool. Thanks a lot.
Yeah, no problem. Great questions, Rob. Thank you. Okay, I think we have some more questions.
Actually, Amiel, just
Yep.
to add to that quickly,
Yes.
when you're speaking to your mortgage broker, when you're speaking to your lawyer, when you're speaking to your accountant, language matters, right? And going back to being transparent with your professionals, when you go in and ask, I'm buying an investment property, should I incorporate? More often than not, the answer is going to be no. If you go in and ask the same question a little bit differently, I'm going in to buy my first investment property, but my goal in the next year is to have 30 doors. My goal in the next 2 years is to have 100 doors. My next goal in 3 years is to have 200 doors. The answer is going to be different, right? You have to give your professionals information to work with to get their best advice. So the responsibility, the onus is on you to communicate your goals if you want great advice from solid professionals.
Absolutely. 100% agree. Yeah. And that's just it, right? The answer on whether to incorporate is certainly going to be different if you're buying just one property, or if the plan is to buy, a number of properties, because it is hard to move from, from personal name to corporate name down the road, right? You're better off if the plan is to buy a lot, better to plan it right from the beginning. Okay, there's a question. So for getting started in real estate without a bunch of capital, what would you recommend as a start? Single family, flip, multifamily, or commercial? Or would you establish relationships to see what's possible given personal financial status? So certainly a good question, right? If there's not a lot of capital, if you don't have a lot of capital up front, then you've got to look at strategies where you don't necessarily need that capital. Or work with other partners, right? And that's exactly how I got started. I didn't have a lot of capital, and which is one of the reasons that I got into rent to own. Rent to own is an amazing strategy. It's it's win-win for everybody, and I think I saw Alfonso was on not too long ago talking about rent to own. So I won't get into too much detail on the program, because I'm sure you guys know all about it. But it's a great program to work with other joint venture partners, because it's for a finite period of time. You already know what your exit strategy is, and you know what your return is on that investment. It's easy to pitch to another investor. And so that's how I got started, was with those rent to owns. But you can do the same thing with any type of a deal, whether you're doing a flip or a BRRRR strategy. You can get joint venture partners to come in and help you with that, whether that's them just providing some capital, or whether that's putting the property in their name and getting the mortgage in their name. Like, there's all kinds of different ways of doing it. And yes, you give up part of the project, but how many of those projects can you do when you're using other people's money and other people's credit, right? That's what it comes down to. So certainly don't be greedy. share the wealth, but also keep in mind that as in a joint venture, everybody's got to bring something to the table, right? And so if somebody else is bringing the capital and the credit, well, you've got to come in with the experience and the expertise, and so it's and being that person that's going to operate the business. The active partner is what I like to call it. So keep that in mind. So in terms of strategy, like, if you're looking to gain capital, then yes, some of those, shorter term stuff like wholesaling or flipping can definitely get you some of that capital in a shorter period of time. But you also have to look at the market as well, right? Like, flipping right now is tough. We don't know exactly where the market is going. We already know that prices have declined significantly in the last, in the last little while, and we don't know if we're at the bottom yet. So you just have to be cautious, right? You've got to make sure that you've got a lot of buffer, set in there for your exit price, right? Give yourself lots of time for completing the renos and all that kind of stuff. So make sure that you are planning for all those things if you are doing something like a flip. So I think any of the strategies can work. You just have to. I think one of the things is picking one and sort of focusing on it, right? Pick a strategy and move forward that way. If it changes down the road, it changes down the road, and that's fine. But what I find a lot of new investors do is that they're sort of all over the place, right? It's like, oh, I'm looking at this flip. Oh, I'm looking at this wholesale. Oh, I'm looking at this big multifamily. And sometimes that can get really distracting, right? And so just sort of narrowing it down and picking up, one or two strategies. Like I said, we were rent to own and multifamily. Those were the two that we were looking at all the time. And where we went astray once is when we started to get into land development, and we shouldn't have, because everything was going really well on the rent to own and multifamily stuff. And then that took away a lot of our time and money at the same time. So that's, being able to focus is definitely important. Okay, I see Rob had made some comments here on the Smith maneuver, and HELOCs for the Smith maneuver creative finance. Okay, awesome. That is awesome. Yeah, and some other comments, great comments. Thanks, everybody. I don't think I missed any of the questions. Oh, any new tax implications for flipping? Make sure you'll profit all these times. Make sure you'll profit in these times for sure. Yes, yeah, there's definitely new rules. And like I said, I'm not an accountant, so I will leave that for the accountants to answer. All right, so I know we've only got about 15 minutes left. Rob, did you want me to touch a little bit on private financing or commercial financing? What?
Sorry, couldn't find the unmute button. I think with the group here, maybe commercial might be a little bit much at the moment.
Yeah, okay.
But maybe some information on approaching private lenders, some of the things, that should do's, don't do, like spray and pray, promise, commit to returns and all that fun stuff.
Yeah.
And really the benefit of working from both sides, working through a mortgage broker that will protect you both.
Gotcha. Okay. All right. So why don't I talk a little bit about private lending. We'll talk about so from the borrower side of things, right? When I look at a borrower coming in for private financing, while it is much easier to get private financing, we certainly do the same due diligence. As a mortgage broker, I do the same due diligence as I would on any other file. So that's something to keep in mind, is when you are approaching brokers, they really should be asking for all your documents and things like that, the same as they would for any other file. That being said, like I did say, it is much easier to get private financing, or I guess I should say they're more flexible. Private lenders are certainly more flexible than what the banks are. If you have no rental income, hey, no problem. The biggest thing with private financing is exit strategy, right? So when you're approaching a lender or a broker and you're asking for private financing, that is, one of the things that you need to be including is, how is the lender going to get their money back? They're willing to lend money as long as they know that they're going to get it back, and you're not going to default on it, halfway through the project, right? So for instance, if you are doing a flip project and you need some private financing to do that flip project, well, what are you using as comparables for your exit after repair value? If you have one comparable and it looks nothing like the property that you're planning on putting in place, that's not going to work. You should come with at least 3 comparable properties, if not more, in the area that you're in, with, same lot sizes, same type of property that you're planning on having at the exit of your project. That's certainly very important. If you're coming in with a BRRRR strategy, right? It's, well, what is the after repair value going to be? And what are my rents going to be? And will I be able to qualify for this mortgage at the end? If you're in private financing right now because you can't qualify for for traditional financing, well, how is the lender going to get their money back, right? What is that? What is that exit strategy? Maybe the exit strategy is that because I can't qualify, we're going to go on the commercial side where I don't necessarily need to have the income to qualify for the property. The property is going to qualify on its own, right? So it's looking at all those things, and that's something that a good broker will help you put together, right? Is what is the exit strategy? What do you want to do? And then can we make that happen? That's always what I'm looking at right from the get-go, is how do we make sure that we get all those private lenders paid back? What else? The other thing that private lenders will look at, so exit strategy is the most important thing. The other thing is who is the borrower? So like I said, it's much easier to get qualified. You don't necessarily have to have the income to sort of debt service the property that we would on with a traditional lender, but they want to know about you. What other properties do you have? Is this your first property? Are you renting? Do you have any assets, right? What is your net worth? And if they're not comfortable with it, because if something goes sideways on a deal, the lender can sell the property, but if you're doing renovations to the property, that property value may have gone down, right? If you bought a property for $500,000 and you tear out the kitchen and all the bathrooms and tear up all the floors, that property is not worth $500,000 anymore. And even if they did 75% loan to value, which is fairly conservative, I guess, right? Then it may not even be worth that amount of money. And the other thing to keep in mind is that if a lender does take a property back and sell it, they have a lot of costs to sell. They've got to pay high-priced lawyers, because all lawyers are high-priced. They like to make money, that's for sure. And then they have to pay a realtor, right? They got to pay a realtor to sell the property. And then as well, they've got all these fees that go on top of it just for defaulting on the mortgage. So in order to get their capital back, there has to be a pretty good buffer. And so something to keep in mind. I'll mention too that, given the current market that we're in, this is sort of what we're seeing from lenders is that they are tightening up a little bit, and they are reducing loan to values because they don't know exactly what's happening in the market, right? They don't know that, in 3 months from now, the property might have, dropped 10%, right? Well, that's if they had lent at 80% loan to value, now they're at 90% loan to value. Right, that's a big difference for a lender. So something to keep in mind in today's market. What else did I want to mention? I'll go over a little bit of the costs in regards to private mortgages, because it certainly is different than with traditional mortgages. So in every private deal, you're going to have an appraisal, because that's what the lender is relying on, right? These are true equity-based lenders, and they are going to rely heavily on the appraisal. Another thing to keep in mind is that you don't necessarily want to go out and order the appraisal yourself. Some private lenders have a specific list of appraisers that they're willing to work with, exactly because they are so heavily relying on the appraisal. They want to work with people that they trust and know. There is a ton of fraud that goes on in the mortgage world. I had no idea until I got in, right? It's crazy. So lenders want to know that they're working with the right people. So appraisal fee typically, anywhere from like $350 to like $550 for that cost. There will be a lender fee. So with private mortgages, you will be paying an interest rate plus an upfront lender fee. So the lender fee is taken off the top right away. I'll give an example. If you have, let's say, a 10% overall sort of rate for your mortgage, that might be split up in an 8% interest rate and a 2% lender fee. Okay, so if the mortgage, let's say, was $100,000, they're going to take $2,000 right off the top. They're only going to advance $98,000 to you on closing. Okay, payments on private mortgages are typically interest-only monthly payments. Again, there's some flexibility there. You can find, potential lenders that will do balloon payments at the end, or lenders that will do amortized payments if that's something that you really want. What else? If you are working with a mortgage broker, as I said before, they will charge a fee. So there will be a brokerage fee associated with that. Typically, it's in the 1% range. There is no guidelines on that. Brokers can charge whatever they want, but that's sort of that's what we charge. We do have a minimum. We have a minimum of about $3,000, just because there is a lot of work with those files. But so 1% or the minimum amount, whichever is more. Legal fees. So legal fees are a big one with private mortgages, because you're not only paying for your own legal fees, you're also paying legal fees for your lender. And so in terms of costs, you know, they can certainly range, but you as the borrower might be around the $1,500 range, and for the lender could be $2,000 to $2,500, you know, sort of in that range, and it does vary very widely. So when you are talking to a mortgage broker about private financing, that's one of the things that you want to be asking is, what are the fees? And legal fees are a big one, because they can vary significantly from lawyer to lawyer. So it's just getting an idea of what their typical legal fees are right up front. That's definitely a good question. The other thing to keep in mind is what discharge fees are on the back end. And that's something that we don't really consider, because we're always focused on getting the money right now. But it's important to know there's always, typically, I wouldn't say always, but in majority of cases, there is a discharge fee, usually $350 to $500. And to be honest, that's standard with traditional banks as well. All the big banks will have a discharge fee as well in the same neighborhood. But then there will also be legal fees to discharge your mortgage. And again, important to ask what typical legal fees are, because those are things that you're going to have to cover at the end. And that's about it from a cost perspective. In terms of private financing, so there are certainly there are two different types of lenders when it comes to private financing. There are private individuals, which would be like when I lend my own money, I'm a private individual. I'm lending directly to a borrower. And the other type is mortgage investment corporations. So mortgage investment corporations, and also real estate investment trusts and things like that, they also lend money privately, but they are doing it with a pool of funds. So they will have a number of investors give them funds, and then they will place those funds. So those lenders can be really great, because they have a lot of funds. They have a lot of capital. On the flip side, they can be a bit more stringent, because they are representing a big pool of people. They have to have very clear guidelines on what they are able to lend on. So just to give you guys an idea on that, they're called mortgage investment corporations, and the number of those lenders out there today is staggering. There are so many of them, and it's increased. You know, in the last few years, they're just adding on new lenders all the time, because there's such a big need for private financing right now. All right, so that's sort of on the borrower side. Any questions on that? I'll touch a little bit on being a lender as well. Any questions? Did I miss anything in the chat, Rob? Oh, is there a certain ROI?
You haven't missed anything.
Is there a certain ROI private lenders want? So yes, for sure. But it varies, right? So I would say it would start with an overall about 10%, and it can go up to there. So for first mortgages, I typically, 10 to 12% is fairly reasonable. For second mortgages, 12 to 15%. And I'm talking overall rate, so rate plus lender fee in that case, right? But if you have, a unique deal or a deal where there's, a lot of risk, then a lender will increase the rate because of it. They will either increase the rate or decrease the loan to value, or both, because they like to be protected and make money. When you are, and so maybe now's a good time to bring it up. If you as a borrower are engaging lenders directly, like if you're asking for money directly, that is something that you can do. You cannot advertise for it, right? But you can, talk to people, and if they're willing to lend you money, then you know what, absolutely, right? And what rates should you target in there? I would think sort of similar, in that similar range, right? I think it's tough to find people less than 10%, but it is possible, and you can negotiate anything that you can negotiate, right? So if they're happy making 7%, I mean, go for it, right? Absolutely. the other thing that if you are engaging people directly is that, you know, there is no broker fee, right? Potentially, you know, some of the other fees could be a little bit less. You just want to make sure that you're representing yourself properly. So on that note, I'll kind of get into the lender perspective. So as I said, I do private lending myself now because I love it. And if you are thinking of becoming a private lender, there are some things to look out for, right? So first of all, if you are dealing with an individual directly, you definitely have to, you know, dot your I's and cross your T's, right? Because you don't necessarily know exactly what they have going on in their whole portfolio. So ask those questions, right? Where I've seen lenders get into trouble with is that you know, going direct to the borrower, you know, lending to people that, you know, maybe have a large portfolio and, you know, it sounds like they're doing amazing, but you don't necessarily know exactly where all of the money is going. And that's where you can get into trouble. So it's just being cautious, right? And if you are working with a mortgage broker, like if a client came to me and said, hey, I got this deal from so-and-so, sounds really good and I want to do it, can you take a look at it? You know, I would, right? I would take a look at it and give you my honest opinions. You know, and definitely have your lawyer review it, right? You know, you definitely want them taking a look at it. But being a lender can be certainly very lucrative. And one of the things when you are lending, whoever is giving you the opportunity, they should be giving you a package to review, right? It should tell you about the borrower. Who is the borrower? Who's lending the funds? Is it going in the corporate name? Is it going in personal name? What do they plan on doing with the property? Is it just a turnkey property? Is it a fix and flip? Are they going to sell it? Is it going to be a BRRRR strategy? Are they going to refinance afterwards? Has somebody looked at the refinance, right? Are they able to qualify for it? You know, those types of things, right? Why are they in private financing right now? Most of our packages are really just, they are private lenders and we're doing a, you know, renovation project and the banks won't finance it anyway, right? But it's important to know all these things. It's important to know all about your the project that you're getting into. So the package that we put together is typically about, you know, 6 pages or so, and it goes through all of those details on the project itself. So make sure that you are doing your due diligence, and as a lender you can ask for whatever you want to ask for, and if they're not willing to provide it, that's when I would be walking away, right? And definitely trust your gut. I did want to touch on too some of the sources of funds for private lending. If you are looking at doing it, you can use cash, you can use equity in your home through a home equity line of credit, you can use registered funds, RRSPs, TFSAs, LIRAs, RESPs, you know, all those different types of funds you can use to invest. So good thing to keep in mind, and especially if you're, as a borrower, if you're approaching lenders, if somebody has money in their RSPs, that is a great source of funds, and lenders are typically willing to accept a little bit lower of a rate of return on their RSPs just to know that they're getting a consistent return on their RSPs, right? It's money that's just sitting there, and you know, if they had been investing it with a bank, it would be going like this, right? And maybe not making anything, as I'm sure we've all seen last a while. So, you know, getting a consistent rate of return on your RSPs is huge. And so offering somebody, you know, even 8%, 7%, you know, could work. Yeah.
Actually, Amiel, one more thing.
Yeah.
For the private lending, when you're going directly to someone you know, for instance,
yeah,
especially when you're starting out, I would recommend having the transaction worked on. Don't be cheap, have it worked on with your mortgage broker to make sure everything goes smoothly at the very least the first time. It shows a level of professionalism to the person you're working with. You have your power team working on it. You're protecting their best interest. We are not lawyers, accountants, mortgage brokers. We can make mistakes. So use your team, right? Let them get paid. But the benefit of paying your professional is you're protecting your investor. And when you do that and you follow through and give them their return, you're going to get a second, a third, a fourth, a fifth deal. You might get referrals from them as well. Don't hoard money. share money because you're going to make a lot more by sharing.
Absolutely. There's a question here. How can we split mortgages between private and banks or mix? So, Mike, I'm not sure if you want to expand on that a little bit, but essentially, like, we can sort of split it however we want. It really depends on your personal situation and what you're looking to do, right? You know, for instance, like if we are doing the BRRRR strategy, a lot of times we will be utilizing private financing upfront because technically speaking, you know, the big banks don't finance flips and renovation projects and things like that for investors. You know, they don't want to get into that. And so if they see that you're doing that on a regular basis, then they can cut you off, right? Blacklist you. So we typically use a strategy of private financing up front to get the property, do the renovations, and then refinance with a traditional institution, because that's what they want. They want that, you know, nice looking cookie cutter home type thing that's rented, right, and making income. And that's what they're after. So it's, how do you split it? It really depends on everybody's situation, and definitely we can be in various products all at once, right? It's not like you have to be in one or the other. We can have some with you know, regular traditional, you know, residential lenders. We can have some commercial mortgages. We can have some mortgages on the B side of lending. We can have some private mortgages, you know, all over the place. And this is exactly what your mortgage broker is gonna help you strategize with, is where do we go and where do we go first, second, third, and all that kind of stuff. Hopefully that answered the question, but if not, pop on and we can expand on it.
All right, Amiel, it's 5 after, and you have family to spend time with. So would you mind dropping your contact information, maybe your calendar link or your assistant's contact information, so they can book an appointment with you if need be? Amiel is not only a really good mortgage broker, but he's a stand-up person, a really good person. He's the type of people that I like to surround myself with. So I can't speak more highly about him than I do. My only requirement when you reach out to one of my contacts like Amiel, don't waste their time. Like, be respectful of their time. If you have the intent of using them, great. If you don't, then don't, right? He does a great job. He has helped us across Canada, and when I get his bill, it excites me because that means I'm making money.
Thanks, Rob. I appreciate the kind words. That's for sure. Thank you. And honestly, I am open and easygoing. So any questions, feel free. I popped my contact information in there. Honestly, the best thing to do is book a Calendly appointment there, and we can have a chat, and I can answer any questions that you might have, for sure.
And you can always review the video on Facebook and get the information, look over the questions, and re-listen to some of the questions. We'll leave it on the Facebook page. But thanks a million, Amiel, for hopping on this morning, and thank your wife for allowing me to do this. I know you're busy with the little one.
No problem. Thanks for having me, Rob. It was awesome. I love this kind of forum where it's, you know, lots of questions and answering questions, getting the information that you guys want. That's awesome. Yeah. So thanks a lot for having me. Thanks everybody for the great questions and being interactive. Really appreciate that. Yeah. Thanks, guys.
Have a great weekend, everyone.
Have a great weekend, everyone.